Okay, let's dive right into this explainer. Today, we're analyzing Tata Steel's investment thesis and operational strategy right in the middle of some serious macroeconomic turbulence. If you're a senior executive reviewing market competitiveness, capital allocation, or industrial scale valuations, this is absolutely the deep dive you need. We're going to break down exactly how a global industrial giant balances massive capacity expansions with aggressive cost transformations, all while navigating a really complex global pricing cycle.
Now hit pause for a second and think about this number, 22.5 million tons. What's highly encouraging here is that this represents Tata Steel India's best ever annual deliveries. It is an incredibly powerful foundation for our analysis today, because it proves that despite all the global trade protectionism, volatile currencies, and fluctuating commodity prices we hear about, the core engine of Tata Steel's volume growth remains exceptionally strong. It's the anchor that actually affords them the strategic flexibility to deal with turbulence elsewhere. Here is our roadmap for today. We'll be looking at Q2 resilience amidst headwinds, navigating Europe's market surplus, cost reductions driving project viability, historic versus forecasted EBIT to growth, and finally, the buy rating rationale. All right, kicking things off with Section 1, Q2 resilience amidst headwinds. So let's unpack the latest quarterly data and see how it builds our initial thesis. The absolute crucial point here is the sheer volume-led resilience of their Q2 performance. Tata Steel logged a consolidated adjusted EBITDA of Rs 89.7 billion. That's a massive 20.3% jump quarter over quarter, actually beating consensus estimates. This was heavily driven by the India business, which posted Rs 85.2 billion in EBITDA on the back of a 5.9% rise in deliveries. But equally critical to the consolidated health of the balance sheet is this: their European operations managed to hit break-even for a second straight quarter. And this perfectly captures the management philosophy behind those numbers. CEO TV Narendran explicitly stated that the company is actively minimizing its reliance on export markets, capping them at around 10%. He said, "We are trying to maximize sales within the domestic markets that we are in. That's the best way for us to build supply chain resilience." By focusing inward in both India and Europe, they're building a fortress. This isn't just a sales tactic. It is a structural defense mechanism against geopolitical, tariffs, and the exact trade volatility we're seeing globally right now. Moving on to Section 2, navigating Europe's market surplus. Okay, we have to address the elephant in the room, the very real, near-term headwinds that are currently challenging all this operational momentum. The European landscape is exceptionally complicated right now. The implementation of the Carbon Border Adjustment Mechanism, or CBAM, in the EU, alongside the UK's plans to tighten quotas for products and increase duties from 25% to 50% to promote local steel, it's fundamentally disrupted the market. These policy shifts, combined with subdued demand, have created a tangible market surplus. And when you have a surplus, well, you inevitably face subdued near-term pricing power. Let's compare the immediate outlook for the Netherlands and the UK, so we can precisely quantify this headwind. While the Netherlands posted a solid Rs 9.2 billion EBDI in Q2, management guidance embeds a transient soft patch. They're expecting a €30 per ton lower margin drop in Q3. Meanwhile, the UK operations, though they successfully halved their annual EBDI loss to $217 million, still posted an Rs 7.7 billion loss in Q2 and face ongoing margin pressure. But the major takeaway for executives here: analysts view this Q3 softness as a cyclical macroeconomic reality, a temporary policy-driven surplus, rather than some kind of permanent structural failure. Which brings us to Section 3, cost reductions drive project viability. So how exactly does management bridge the gap? How do they survive these short-term European headwinds while aggressively funding long-term capacity growth? Well, through their primary operational lever. They aren't just sitting around waiting for prices to recover. They're executing a sweeping cost transformation program. They are aggressively targeting raw material efficiency, optimizing stores, repairs, and maintenance, and managing the heavy end closure at Tata Steel UK. It's a comprehensive, systematic approach to pulling costs right out of the ecosystem. Let's look at the actual numbers behind this transformation, because they're impressive. They've already achieved a staggering Rs 10,868 crores in savings historically. Now, they're targeting another Rs 7,140 crores, that's roughly $0.8 billion, by FY2027. This is driven heavily by curtailing those UK losses and optimizing iron ore pellet sourcing from recent acquisitions. Why does this matter so much to the big picture? Because Tata Steel is committing to a massive capital expenditure of INR 100 to 200 billion annually over the next few years.
These cost efficiencies are the exact shock absorbers that offset this heavy capex. It's what allows them to fund massive growth projects like the Kalinganagar expansion without blowing out their leverage or sacrificing long-term viability. Let's jump into Section 4, Historic versus Forecasted EBITDA Growth. Let's translate this strategic groundwork right to the balance sheet, looking forward from fiscal years 2026 to 2028. Notice how rating agencies, like S&P, view the payoff of these investments. S&P forecasts a dramatic jump in EBITDA from an estimated 319 billion INR in FY25 to 412 billion by FY26. That is earnings growth fueled entirely by higher volumes and those exact cost efficiencies we just discussed. And more importantly, look at the FFO to debt ratio, funds from operations to debt. It climbs from a suppressed 15.4% back in actual FY24 up to a highly healthy 26.7% by FY26. For credit analysts, maintaining this ratio comfortably above 20% is exactly what sustains their investment-grade BBB rating straight through the steel price cycle. Corroborating this narrative, we see equity research from MK projecting a very similar, aggressive and steady climb. They map the journey from actual FY24 EBITDA toward that 400 billion INR mark by FY28. A massive catalyst for this forecasted growth, the ramp-up at the Kalinganagar facility, which is slated to add about 2.5 million tons to total output. That's going to vastly improve product mix and EBITDA per ton. The consensus across the board is clear. The structural capacity additions are absolutely expected to dwarf the current cyclical softness. Finally, Section 5, the buy rating rationale. So let's tie all of this data together into the final investment verdict. How on earth do analysts reconcile a weak next quarter with a buy rating? Well, the crucial takeaway from institutional analysts, highlighted perfectly in this MK Global quote, is that they are looking entirely past the immediate quarter. Yes, they explicitly factor in a soft Q3 due to weaker realizations, a $6 per ton rise in coking coal, and that subdued European backdrop. But their target price of RS200 and their buy rating remain anchored. Why? Because the underlying structural strengths, the Kalinganagar expansion and the 7,140 core cost transformation, completely overshadow the transient Q3 softness. They're already pricing in the expected policy inflection and long-term volume dominance. As we wrap up this explainer, I want to leave you with a provocative question to help frame your own capital allocation strategy. Does the structural promise of FY27, with its optimized cost base and millions of tons of new high-margin capacity, truly outweigh the geopolitical turbulence and market surplus we are seeing today? The data suggests the foundation is absolutely built for massive leverage, but the execution over the next few quarters will be the true test. Thank you so much for joining me for this deep dive.